Hello, today is November 3rd, 2021, and it's time for some new stock picks. As always, we're going to review the investment recommendation stock picks from this time last year. And this time last year, we had a tech stock, Logitech, a maker of mice and peripherals and other equipment like that. It's up 3.7% since the day that we recommended it. Natural Beverage up 57.3%. Infosys up 58.9%. And we also recommended a bonus, if you will, investment idea, natural gas. And for Canadian investors, we said the HUN ETF was the way to do it. And HUN is up 48.3% in Canadian dollars. And as the Canadian dollar has appreciated, it translates to 59.2% in US dollars. So the average of the four recommendations is 44.8% in US dollars. And that compares with the total return for the MSCI World Index ETF of 29.3% in US dollars. This time around, we are not going to have a tech stock in the top three picks, even though this time last year we had two of them. The idea behind that is rates are going to be going up, interest rates are going to be going up in the next 12 to 18 months, and the result of that will tend to be perhaps lower PE ratios for the high growth stocks, and the tech stocks tend to be high growth stocks, and they tend to trade at high PE multiples. And while we don't recommend getting out of tech altogether, a neutral weighting in technology or slightly underweight position in technology, 20% or thereabouts of a total stock portfolio exposure would be appropriate. So first pick is going to be a Canadian bank, the TD Bank, one of Canada's largest banks. Canadian banks, I believe, are trading at a lower valuation than they should be based on their fundamentals. So they kind of need to play a little bit of catch up with the US banks and other banks around the world. Valuation wise, for example, TD Bank is trading at a PE ratio of it's around 11. And the return on equity for the bank is somewhere in the 14% range. And the price to book value is somewhere in the 1.8, 7.5 range, and it should be closer to 2, so it's slightly undervalued, and it has a good probability of continuing to deliver the same type of return on equity going forward, and even without a valuation increase, it should produce double-digit returns, total returns for investors going forward. So that's going to be a top pick. The next one is going to be a US stock. Comfort Systems USA, symbol FIZZ. They are in the contracting services business, heating, ventilation, air conditioning, plumbing, piping for construction or commercial, industrial, those sort of buildings, either newly constructed or maintenance services. The company is doing well, the stock is doing well, the valuation is reasonable, and we expect there's going to be continuing demand for their services going forward. So we expect a good company performance and stock performance for the next year and beyond. The third pick is a gold miner, Barrick Gold, symbol ABX. Gold miners are a little bit hard to value, and traditionally we have stayed away from mining companies, including gold miners. That is because the underlying commodity is used by the market as a substitute for cash, as a substitute for bonds, as a substitute for other types of investments. Gold is being used as a reserve by central banks, is used by investors to keep up with inflation as an inflation hedge for their portfolios. And gold tends to be zero correlated or uncorrelated with equities. And gold miners have to have a lower correlation with other equities. And in the past, investors have required a lower rate of return from the gold miners than from the rest of the stocks because of their low correlation to the remaining portfolio. And with lower expected returns in the region of like 4 or 5%, we weren't interested in those type of investments. Especially since they can be quite volatile. But I believe now the expected return from miners like Barrick is going to be closer to 10%, perhaps even double digit, even without gold prices going up. As the valuation on the miners, this one in particular, is somewhat attractive, trading at roughly 1.4 times book value, with a return of equity in the 10, 11, 12% range. It will give us a high single-digit return with going forward, assuming no price changing in the price of the commodity. And that should make for a reasonable investment going forward. If you like a second opinion as to whether these or how they fit into your existing well-diversified portfolio, if they do at all, please give us a call. Thank you.